that we keep hearing about is NPS. In your opinion, can NPS be a good option for retirement planning? And also,
Yes.
do annuities make sense? Also, what about PF in your view, especially with EPFO now allowing higher amounts to be contributed? How would you, advise investors should choose these kind of instruments?
Okay. Good, very good question again, Shona. So thank you. So firstly, NPS is a wonderful product, and it's literally a zero cost product, extremely well structured by the government of India. And especially for salaried people, there is a double benefit of NPS, which most of us don't understand. A salaried person, where the employer is giving the benefit of deducting NPS, which is voluntary. But if the employer gives you the benefit of deducting your NPS, you actually can give 10% of your basic every year to NPS, which is deducted at source before your salary is paid. Okay, so it's not taxed. And additionally, you can put another incremental money into NPS from your post-tax salary after you receive. It's like pretty much like EPF and PPF. EPF is done at a employer level, and PPF is what you contribute after you have received your salary. So if you're a salaried person, NPS not only helps you systematically save a lot of money every month, it also gives you fantastic tax benefit. And NPS is a market-linked instrument. So underlying, you can choose your fund managers, which mutual funds you would like to manage your money. And there is an auto mode, and there is a mode at which you can control. So if you give auto mode, according to your age, the asset allocation will reduce. The equity part of the asset will reduce. But if you take a self-chosen mode, you can have a consistently higher equity allocation for during the accumulation phase. So on an average, NPS now over the last 15 years has given about 9 to 10% return, which is extremely good, which is higher than the corresponding fantastic instrument, which is PF. So PF, as you know, Government of India provides extra returns because it is meant for employees or retirement benefits. Now, in PF, there are caps that has been introduced because people were taking undue advantage of that extra higher return. So now, incremental contribution to PF through voluntary provident fund schemes or provident fund, public provident fund has become a little tax inefficient. So an ideal asset allocation for your savings can be first PF employee plus employer, keep it to that. Don't increase it unnecessarily. Definitely number 2 is NPS, contribute maximum that you can in NPS. If your employer does not have the benefit of NPS, then talk to your HR and tell them to give you that benefit. And thirdly, any incremental money over and above these two should go into a diversified equity mutual fund through systematic SIP route. And there are certain solution funds like children benefit fund, like retirement funds. So if you can start an SIP in 4 funds, so 4 schemes, at least take one of them into a solution fund. If you have a small kid, try to take a children fund. If you are wanting to put it specifically for your retirement, put it in one retirement fund. They are not different animals. They don't give you extraordinary high returns. But just in your portfolio, when you see that presence of the children fund or the retirement fund, it tends to keep you invested for a little longer. As you know, that the biggest worry and the biggest problem for Indian investors has been to stay with the investment for long. So while equity markets have consistently given more than 15 to 20%, around 15% return for the last 30 years. An average Indian, if you ask, they will say my real estate is better than equity. Because in a real estate, they buy to stay invested. And when they stay invested, they get 9-10% return, which is higher than any fixed income. So they say it's a fantastic return. Same is happening to gold. When you have gold in the family, you don't sell. And when you hold gold, you are seeing you are making 10% return. But equity, if you are bought and held, you would have made 17% return. But unfortunately, you don't do that. For every alternate quarter, there will be some bad news and you tend to exit the market. So that time, that name retirement and that name solution in that fund scheme will help you stay a little bit more, a little longer.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.